You're watching Daily Market Pulse. Today is Friday, April 24, 2026. If you want a clean daily read on macro and market risk, subscribe for the next briefing. 7 top macro analysts just delivered a unified warning. Inflation is back, the dollar's weakening, and Bitcoin is emerging as the primary hedge against what's coming next. Here is the framework for today's briefing. Energy crisis impact. Iran conflict creating structural oil shortage. Money supply explosion. Commercial banks driving inflation at 7% growth. Commodity supercycle. Backwardation signals sustained higher prices. Bitcoin vs gold thesis. Digital gold for private portfolios emerging. Dollar debasement risk. Central banks hoarding hard assets defensively. The Iran conflict just changed everything for energy markets. The Iran conflict has created severe disruption in the Strait of Hormuz, causing extreme backwardation in oil markets, with a $12 spread between front-month and December contracts. This indicates tight physical supply that extends beyond crude oil to energy-intensive products like fertilizer and sulfuric acid. This isn't just a temporary geopolitical spike. The market is pricing in a short-term disruption, but analysts warn the structural reality suggests months of supply constraints. U.S. shale production has stalled with 0 new rigs, meaning no rapid supply response is coming. Oil futures are showing extreme backwardation, providing positive roll yields for long positions. Equity markets are rallying on hopes of quick resolution, but this optimism may be misplaced given the structural nature of the supply shock. What to watch next? Monitor Strait of Hormuz developments and WTI deferred curve roll yields. Any escalation could trigger the 350-barrel scenario that would force global demand destruction through recession. But energy isn't the only inflation driver accelerating. Commercial bank lending is growing at approximately 7% and accelerating, with banks generating 80% of the money supply through credit creation. Bank regulations are loosening while earnings remain strong, creating an effective monetary easing cycle independent of Federal Reserve policy. This is the real inflation engine that Wall Street is missing, while everyone focuses on oil prices and supply shocks. The monetary foundation is being laid for persistent broad-based inflation through endogenous money creation in the banking system. Traditional inflation hedges are gaining traction, while bond markets haven't fully priced in the implications of accelerating money growth. The productivity boom narrative from tech is being dismissed as markets focus on monetary realities. What to watch next? U.S. commercial bank lending growth data releases will be critical indicators of whether this monetary expansion continues accelerating beyond the 7% threshold. This is creating a broader commodity supercycle. Multiple commodities are showing backwardation patterns, with gold entering a secular bull market targeting $6,000 to $7,000. The global economy is shifting from just-in-time to just-in-case inventory strategies, creating structural demand for hard assets and raw materials. This represents a fundamental change in how the global economy manages supply chains and strategic reserves. The shift to precautionary hoarding creates permanent demand elevation for commodities, establishing higher price floors across the sector. Commodity futures with backwardated curves are providing positive roll yields for long positions. Central banks and institutional investors are aggressively accumulating hard assets as defensive positioning. What to watch next? Monitor backwardation patterns in key commodity futures and central bank gold accumulation data as indicators of institutional positioning for the supercycle. And Bitcoin is getting validation as digital gold. Leading economists are explicitly validating Bitcoin's role as digital gold for private portfolios, while rejecting the concept of government Bitcoin reserves. The consensus is that private individuals should hold crypto as a hedge against dollar depreciation rather than state adoption. This represents institutional validation of Bitcoin's monetary properties without the complexity of government adoption. It positions Bitcoin as the primary non-sovereign asset for private wealth preservation during the emerging inflationary environment. Bitcoin is positioned for medium-term bullish trajectory despite potential short-term volatility from initial risk-off sentiment. Capital is expected to rotate away from fiat and into non-sovereign assets for purchasing power preservation. What to watch next? Monitor Bitcoin's correlation with inflation expectations and its performance relative to traditional safe havens during energy price spikes and monetary expansion. The dollar itself is becoming the problem. Central banks are aggressively accumulating gold to hedge against dollar inflation, not to replace the dollar as the global reserve currency. The long-term bond bull market has ended, with yields expected to rise as inflation accelerates through monetary expansion. This signals a defensive pivot by major institutions away from dollar-denominated assets. The traditional deflationary narrative that supported bonds and growth stocks is collapsing as the macro environment shifts towards sustained inflation. Hard assets are outperforming fixed income as investors rotate away from bonds and tech-heavy portfolios. The flight from traditional safe havens into inflation-resistant assets is accelerating across institutional portfolios. What to watch next? Track central bank gold purchases and bond yield movements as key indicators of institutional confidence in dollar-denominated assets and inflation expectations. So what's the bottom line from today's analysis? We're witnessing a fundamental shift in the macro environment. Supply-side inflation from energy disruptions, accelerating money creation from commercial banks, and a weakening dollar are converging into a perfect storm for hard assets. Bitcoin is being validated as digital gold for private portfolios, while traditional gold targets $6,000 to $7,000. The deflationary narrative is collapsing, and investors need to position accordingly. The message from 7 top analysts is unanimous. This isn't temporary. Thank you for your attention, and we will see you again tomorrow.